In March 2026, the World Inequality Report confirmed a structural reality that most financial advisors are paid to ignore. A tiny global elite, the top 0.001%, now controls 3 times more wealth than the entire bottom half of humanity combined. But the real theft isn't in the raw numbers, it's in the yield gap. Every year, roughly 1% of global GDP flows from middle-income sectors into the hands of the ultra-wealthy through excess yields and interest payment arbitrage. This is 3 times the amount of all global development aid. The system was never designed for you to win. It was designed for you to provide the liquidity that the architects used to build their own empires. Today, we stop being the liquidity. To understand why you're losing, you have to look at the global K-shaped divergence. In the West, the US and Europe, we see a paper economy at record highs. The S&P 500 is now more than twice the size of the actual US economy. This is the top of the K. It is driven by equity gains that 90% of the population cannot access. Juxtapose this with the physical economies of Asia and emerging markets. While the US is printing paper promises, countries like China and India are aggressively stockpiling the physical truth. They are cornering the markets on copper, uranium, and gold because they know that in a 2026 economy, you cannot build a data center or a power grid with a central bank digital currency. You need the atom, not the bit. If you are positioned 100% in paper assets, while the world's superpowers are pivoting to physical reality, you are on the downward arm of the K-shape. Let's look at the predictive data for the next 18 months. As of late March 2026, we have entered a structural shortage. The International Copper Study Group has officially abandoned its surplus projections, now forecasting a deficit for 2026. JP Morgan's models are even more aggressive, projecting a 330,000 metric ton shortfall. At the same time, uranium spot prices have shattered the $100 per pound ceiling, driven by an unprecedented demand for AI-driven hyperscale data centers. Predictive analysis. Each new hyperscale facility requires up to 50,000 tons of copper. This is a structural revaluation. If you are holding cash at 5% interest, while the raw materials required for the global AI build-out are entering a 20-year scarcity phase, your savings are being liquidated to fund the infrastructure of the elite. The prediction is simple. By the end of 2026, the inflation-adjusted yield on cash will hit its lowest point in the decade. Those who own the source will set the price. Those who own the paper will pay it. If the system is rigged, you don't play the game. You own the board. This requires a 3-step technical execution. Step 1. The 31.30 audit. Perform a real yield check. In 2026, if your assets aren't yielding at least 15.1% annually, the current benchmark for maintaining high income status, you are mathematically insolvent. Cut the zombies, specifically underperforming bonds and low-yield REITs. Step 2. The physical arbitrage. Institutional investors are exiting tech software and entering infrastructure hardware. The metals and mining ETF, known as XME, is your primary mechanism. It captured an 87% gain over the last year because underlying mining companies become exponentially more profitable as resource prices climb. It is your hedge against a devaluing currency. Step 3. The liquidity strategy. Central banks are currently mopping up trillions in liquidity through open market operations. Your move is to hold dry powder in money market funds that track peak interest rates, currently reaching 4.0% in the US and significantly higher in growth markets. This isn't saving, it's positioning to buy the assets the middle class will be forced to sell during the next liquidity squeeze. The 2026 World Inequality Report isn't a prophecy, it's a diagnostic. It shows that the gap between the 1% and the 99% is no longer based on what you earn. It's based on what you hold. One group is waiting for the system to fix itself. The other recognizes that the system is the problem and has chosen to build outside of it. You are no longer a retail investor hoping for a green day. You are an asset architect. Subscribe to this channel if you are done playing a game you were never meant to win. We are auditing the specific physical truth tickers in our next briefing. Become the architect or remain the liquidity. I'll see you in the audit.